Hello, I'm Asif Farouk of Finextra, and I'm here today with Michael Davison, Nigel Guenole and Nick Trigg of IBM, and we're going to be talking about enterprise conduct risk. So Michael, I'll start with you. The FCA has been very clear in what it means by good conduct with regards to financial institutions, but what does it actually mean in this context, and how is it different from other kinds of risk?
Well, it's a very interesting question, Asif. Martin Wheatley, who's the director of the FCA, wrote something very interesting back in 2012 in his address, Journey to the FCA. He said that from the boardroom all the way through the organisation, everything they do has got to be about good conduct. And in my mind, that's very different from simply saying stopping doing bad things, so misconduct. And I think one of the interesting aspects of conduct is people think about the risk of it rather than perhaps focusing on the main issue, which is how does an enterprise conduct itself? So that's why we call it enterprise conduct risk. And another interesting thing about it is that there are many facets to conduct in an enterprise, clearly for a complex institution like a bank. And what we've done is to look holistically at what they look like. We've identified 7 or 8 different areas, or domains we call them, which intersect, which means that conduct risk is qualitatively different from other kinds of risk because the sources of risk and their impacts are contagious. Okay? So if you look at how a corporation, for example, espouses its values and how that's reflected in its culture and its behaviours, that's very closely linked to 2 other functional areas. One, the way in which human resources recruits, incentivises and pays its people. And obviously the risk appetite of a business, the risk function which drives it, is influenced by that. So human resources and risk is involved. Certainly the central values of the business is centrally involved, and those interlinkages are quite subtle. There's also something around the attitude of the financial institution towards a regulation and its own codes of conduct. Some financial institutions are very compliant, others choose to be more belligerent in their stance towards a regulator, particularly some of the larger banks. We know that there's an important focus in the FCA at the moment on product and service design with a view to getting a balance better between the benefits to the consumer, be it a financial markets a customer or a retail consumer, getting the balance of reward right. At the moment there's a concern in the regulator that a reward is skewed in favour of the supplier, and so product and service design is under scrutiny. Equally, the processes that come from the specification of a product are also under scrutiny, and the sales forces that deliver them. So immediately you're looking at business processes, the evidencing of compliance against those. The other major focus is actually on through-life care for long-term contracts, typically a retail mortgage. So we also know the regulator is interested in looking at through-life suitability, particularly for consumer products, and ensuring that the customer is able to repay all the way through as opposed to simply at the inception. Okay? So there are other domains as well, but that just gives you an idea. It's a complex task and therefore needs to be addressed in a different way.
Great. Okay, Nigel, let's move to you. What are some of the causes then, you think, of poor conduct?
Well, Asif, there are many causes of misconduct, so we need some way to frame these. I find a very useful way to frame these is to think about the causes in terms of factors about the individual and factors about the work environment. If you think about factors about the individual, some examples are personality dimensions that lead people to commit misconduct. That might be low conscientiousness, it might be overconfidence, it might be low integrity. These workers might also have inadequate technical capability for the financial roles in which they find themselves, and they might also have poor judgment. Now, on the work environment side, what we might find is that there is inadequate regulation and governance in place. The technology might not support appropriate ways of working, and there might be a poor culture in place where risk-taking, for example, is encouraged when it needs to be discouraged. The point that we need to note is that these different types of causes lead to different types of misconduct. So some of those types of misconduct are, first of all, accidents. These just happen and they are very difficult to predict. On the other hand, sometimes people know that something's wrong and they do it anyway because it's a shortcut. So there is shortcut taking that people take, and we would like to try to remove that. And then at the very extreme end of the spectrum, what we have is intentional wrongdoing, and the intentional wrongdoing is what we really want to stamp out. And when we think about how we're going to stamp this out or how we're going to mitigate the risk of misconduct, we can think about stopping factors about the individual that they bring to the workplace by not letting them get into the workplace in the first place with predictive hiring solutions. And we can monitor what is going on in the organisation once the workers are already there with different sorts of analytics. For example, we have social analytics where we can monitor online intranets, for example, in organisations to assess the sentiment of the business. We can also assess levels of engagement, and we can monitor social media to see if we can get hints of misconduct early on. So the point about these analytics efforts is that they can prevent the individuals coming into the organisation who might commit misconduct, and they can monitor what's going on in the organisation, so when it does happen we can intervene and stop it.
Sorry, you spoke about social media. Is this purely for the intranet, or could this be applied for an employee's outside of work social media use as well?
It can be applied outside of work as well. So the applications that I'm talking about here are primarily intra-organisationally focused, but there are examples of where you can monitor external social media for this purpose as well, yes.
Nick, let's move on to you. What type of governance then should a financial institution have in place to manage conduct risk?
Well, let's have a look at its simplest form. In its simplest form, a set of governance is basically a way that the board of any financial institution can identify what their goals are around this area. They can actually embed those and encapsulate those in a set of policies and procedures, if you like. But the key thing here is, how are those policies and procedures implemented? They need to have comfort that the goals can be achieved, the policies are in place, and they have fair warning of how that is being deployed, if there are any issues around that. So you're looking at encapsulating that within policy procedures. You're looking at that as sort of a company-wide thing. So with conduct risk, you have company-wide objectives, but you also have to bring those down into specific areas within context of your business. So, within a business process context, within a product context, and within a behavioural context. And I think what you need is the purpose of a governance system, if you like, is to act as almost the engine management system. So around this, you have many techniques, tools to analyse people's behaviour, to incentivise people's behaviour. And I take the point earlier made, it's not just a question of policing the process, it's a question of enabling the process. In other words, you're not just catching things that people have done, you're encouraging them for good conduct in that area. And I think the interesting thing about conduct risk is that that behavioural aspect, and the sense it goes across across the organisation, and therefore the silos need to be broken down around that area. So if we treat that as an engine management system, we're now looking at taking information in. A product like IBM's Open Pages GRC will take all of those connections between the business, the process, the first, second and third line of defence within an organisation, and be able to cut and slice that information any way you like. So you need to be able to surface that information, dashboard that information, give early warning of adverse trends, give evidence, which is critical for encouraging trends, and therefore we're to take the action itself. Because if you look at a conduct or piece of behaviour, it has multiple impacts. It has a compliance impact, it has a business impact, it can have a legal, reputational, brand impact, right? So this is actually interlinked with all of the other types of operational risk you have, and you have to have something that brings all that together, as I say, like an engine management system.
Interesting. Okay, lastly, let's move back to Michael now for an overview. What else should financial institutions be doing?
So it's a great question. Financial institutions, great and small, are in the spotlight. The regulator is looking very specifically at a whole range of different areas of potential misconduct. The challenge that the sector faces is, where do they focus? Many of them at the moment are focusing on the winkling out and stopping clear misconduct. In so doing, they may be in danger of looking through the wrong end of the telescope. Okay? So what we're advocating is take a step back and look at the whole picture and then ask themselves, are the measures, the probes, the data streams that we have established to monitor and analyse what is going on adequate? Or do we still suffer from, to use Nick's word, do we still suffer from siloed data where everything looks okay in a particular business, line of business or shared service or function, but actually the areas in which misconduct can bubble up and the risk can creep in are simply go through the cracks, they're not seen. We know this is complex, and that's why we're very keen to communicate the importance of looking at it in an integrated way. And by integrated, I mean enabled through technology to look at and create measures which are holistic. They cut across different business areas. They recognise, as Nick said, the various contexts, and they enable boards to see, not just a sea of greens, ambers and reds for a particular stovepipe, but actually look at those crosscuts and say, are we sorting out these issues? Are we designing products better? Are we designing the way in which we promote, retain, release our employees? Are they in place? Is there consistency across the enterprise and so on?
Also, just one point about
Yeah.
this, take out this aspect of ownership, of where this, who owns this conduct risk situation within the bank or within the financial institution. And of course, it does start at the board level. They own that. They need to set that tone at the top. They need to have some method of encapsulating that and driving it through. But at the end of the day, everybody almost within the bank owns that. Everyone executes against that culture, if you like, and that set of objectives.
I just wanted to extend there because that's something that we hear a lot. Everybody's saying that it's culture and they're saying that it's tone at the top. They're saying that it's leaders that need to be responsible for changing the culture. But when you have a think about it, there's only a few people on the board, but you've got hundreds of thousands of people lower down in your organisation. So it needs to start at the bottom as well.
Well, thank you all for joining me today. Appreciate it.
Thank you.
Thank you.
Thank you.